Good evening, everyone, and welcome to this session for the All-Party Parliamentary Group on Blockchain. Absolutely delighted to welcome you all this evening, and I hope you enjoy this evening's panel session. It's extremely informative and also, I think, very topical around the issue of central bank digital currencies and stablecoins. Esteemed panel tonight, notably Natacha Valla from the European Central Bank. Though Natacha sadly won't be able to join us, is giving a recording. Christian Catalani, co-creator and chief economist at Diem Association. Rhomaios, CEO of Fnality International. Jonny, advisor at the Stratis platform. And live from Washington, I've always wanted to say that, live from Washington, Commissioner Hester Peirce is the US Securities and Exchange Commission. As usual, I'm very grateful for the sponsors of the All-Party Parliamentary Group, which enables this forum to take place. I know that there are members of the House of Commons and also the House of Lords watching this evening, as well as the advisory board for the All-Party Parliamentary Group. I won't waffle on too much because I want to bring in of course, Birgitte Andersen, Dr. Birgitte Andersen, CEO of the Big Innovation Centre, to say just a few words. Birgitte, over to you.
Well, and good evening, everybody. And of course, the Big Innovation Centre be very proud to be the Secretariat for the APPG and blockchain. And today we have an amazing panel, but also an amazing subject to be discussing. And of course, in the UK, we have had quite different discussions on this topic in which many people have very different views. So we clearly look forward to learn something tonight. And we should not forget, this is about evidence getting into Parliament. It's about also informing parliamentarians to make more informed decisions in this area. So everything tonight will be recorded and shared with the government departments and the wider Parliament afterwards. So I also want to say, just before I hand over to our conversation, that next week we are on the 3rd of November, we are launching a major landscaping report on the blockchain industry in the UK, and 1.6 billion pounds has been invested into our companies more recently, and the major part of that is, of course, crypto and fintech. So we look forward to this, and if you want to participate in that, I'll just put the link into the chat. And and I'll hand back to Martin.
Thank you, Birgitte. And just before I head in, just advise as usual, given that we're doing this virtual and I'm doing it from a parliamentary office, you may hear some very strange noises. Those are bells and whistles that happen in Westminster to notify members of sometimes what's going on here, and you may hear a very loud bell in case there's a vote. So just in case that happens, that's what it's about. So Birgitte, thank you so much indeed. We're going to go into our first panelist who, as I say, couldn't be with us today. Natacha Valla is also chair of the SUREF, the European Monetary and Finance Forum editorial board, and she's giving us this presentation right now.
Good afternoon. I'm very happy to be with you today, this afternoon, and I'm sad not to be interactive. But this is an event organized by APPG on central bank digital currencies and stablecoins, with the idea to assess a new monetary policy paradigm. And this is something which is very dear to my heart, also because I just published a book on the future of money, which will be translated in English very soon. So I hope my thoughts will bring something to the discussion. Now, before going into more specific points about CBDC, central bank digital currency, I would like to come back to the fundamentals of the link between money and the central banks as issuers of fiat money. And one fundamental characteristics beyond the uses and the functions of money that everybody knows is trust. And by trust, I think it goes way beyond, a weakly defined psychological feature. It is something that is very articulated with the way in which we all interact together. We all make society and our collective entity. And those articulations are, and this is something we develop in the book, of three orders. One is methodological, the second one is hierarchical, and the third one is ethical in some way. Methodologically, it's very easy. It's very horizontal. It's the routine role of money, the way we use money to exchange, the famous functions, to store value, to in our daily lives. So this is a sort of legitimacy that we get by the usage, by the repetition of having money into our lives. But there are two other dimensions to the legitimacy of money and the role of money for us. The second one is hierarchical. And here it really pertains to the role of money and therefore the central bank as a pivot in the payment systems. And the payment dimension of money is very key in the development of stable coins or other alternatives, and as an argument for the development of central bank digital currencies. So being a pivot in payment systems is key, and the central bank, as of today, as the issuer of fiat money, is also the guarantor of the ultimate settlement, ultimate finalization of payments. So that's the second dimension, which is key to be kept in mind when we speak about CBDC, because this is always true. The third one, which I call ethical, which might be a bit of a bold word, but comes to the fact, and this is also a fundamental element when we discuss stable coins, when we discuss crypto assets, is that central banks in the constitutional orders that is characterizing our systems, our democratic systems, they are a centerpiece of this constitutional order, and they are the delegates of the state of the sovereignty of the monetary order. It's not just anything, it's a representative of the sovereign expression of us being together, namely the state, and as such it is the legitimate issuer of fiat money. And I think those elements are to be kept in mind when we speak about alternatives and alternative forms of money. Now, why are central banks coming now to CBDC? I think it was a bit of a wake-up call, but a very useful one, because the central banking community has taken a long time into recognizing that it might be a good idea to be in the digital space, at least in that way. And they suddenly recognized that they should, increase the pace of adjustment because of the changes in the world we live in. We live in a world where phones have become completely pervasive to our lifestyles, changed our productivity in the work environment, but also our private life productivity, so to say. They recognize that way that data is a dimension of everything today, and that data has value, which was not really the case with other forms of central bank currency. And they recognize also that economic activity, that our lifestyles are changing. This is also, from a more technological point of view, them waking up to the fact that those technologies can be extremely useful for the fulfillment of their fundamental functions and the fulfillment of their mandates in terms of macroeconomic stability, price and stability, and for some central banks also growth objectives. And this has been triggered obviously by the fast pace at which the private sector has been developing those technologies. And I hope that there can be a hybridation between this technological excellence and the functions and the fundamental role, democratic role and constitutional role of central banks being expressed through CBDCs. So if you look at what central banks have been saying, and then I'll say a few words about the pace at which they've said that, they all say more or less the same thing. The first reason why they are going towards CBDC is what I just said: the evolution of the economy, the evolution of the way we produce value collectively. Second one is the progresses and the changes in the payment system space. And here I think there's a stability argument, but there's also an efficiency argument. And because the payment function is so closely related to the concept of money, they cannot afford to be left out of it. There's also the dimension of cash, the use of cash, at least for transaction purposes, not for, other purposes, but for transaction purposes in many places in the world is really going down. So there needs to be a way, they say, for them to keep the direct connection to the citizen. And the direct connection to the citizen used to be the banknote. It could be a digital euro or digital pound. There are also dimensions that are not so univocal, but I think are very important. At least I view them as very important. Those are international dimensions related to the implementation of CBDC and related to the coordination of CBDC initiatives across monetary areas, different areas with different currencies. This international dimension has, as a first expression, the way CBDCs and networks of CBDCs can complete the international monetary system. So far for currencies to interconnect with each other, we had, FX markets, obviously, but we also had some kind of hybrid expression of a sovereign money, and the only one was the SDRs of the IMF. I think that was a useful concept, but a very embryonic one, and the implementation of CBDCs by all major currency areas will allow us to see how they can interconnect and how they can ensure, the international financial stability. And the other international dimension is the cross-border payments dimension. I won't enter into that because it's a very deep and broad discussion, but I think it should be really underlined. I think I'm coming close to the time that was allotted to my words. I would just want to conclude on the worries that central bankers might see and might express through running now towards implementing CBDCs. They were worried by seeing, crypto assets, and in particular stable coins, that are the ones that come as close as it gets to fiat currency and sovereign currencies. Is manifold. They might have worried, of course, because it's a very lucrative business, about seigniorage revenue, and this is something that private initiatives have identified very clearly. There's the currency area dimension that I was mentioning. We need a digital currency area to match a digital economy. Will those alternative assets jeopardize sovereignty? That's a key existential dimension for them. And another dimension, which is not so much a worry for them, but more for the financial intermediaries around central banks, is the role of financial intermediaries in a world where central bank digital currencies are implemented. In particular, the role of the banking system in intermediating, in transmitting monetary policy, but also in making their job of deposits collection and credit making. I would not worry at all on this, because I think central banks have only incentives to protect the financial ecosystem that has been made safe, regulated, stable, that has a long history of interaction with themselves, and central banks in developing CBDCs will have to be careful in protecting the stability there. And I think on the contrary, there will be a lot of business opportunities for financial intermediaries, banks in particular, but financial intermediaries to be made in this transition to a CBDC world, which I see as very imminent. In fact, I mean, you see CBDCs being implemented in some places already, but I would like to take an illustration, and that's really my final word of the way that the speech of central banks has evolved, regarding CBDCs. In 2020. The ECB has issued a report on CBDCs, saying, very hypothetical, there might be scenarios under which we want to go there, 2020. And now, 2021, second half, we see real pilots in the Euro system. The Banque de France has simulated already actually an initiative with Seba Bank for the settlement of listed securities, with the usage, so the delivery being triggered by the Target 2 Securities system, which is existing in the euro area, using existing features of this Target 2 Securities system, in particular on conditional securities delivery. And technically that worked very well. The Banque de France simulated a CBDC issuance on a public blockchain. They developed and deployed a dedicated smart contract for that, and they managed, at least that's the perception, to control the confidentiality of transactions. So steps are being made. They have a lot of brain power, a lot of resources to allocate on this, and my hope is that they go as fast as possible into implementing those solutions and getting them to the customer, to the citizen, and including them into the ecosystem of the fantastic technological advances that have been brought forward by the private sector. So I'll stop there. Sorry for being a bit long, and I hope the discussion will be lively and interesting. Thank you very much.
Well, I'm grateful for Rachel's presentations, and I think it's already brought on some questions in the Q&A section. Sadly, we can't actually ask. So can I just ask Natacha? I think really kind of informative kind of approach from her perspective on CBC, and I hope we can maybe have a bit of discussion at the Q&A. If you do have any questions, please do them in the Q&A tab at the bottom of your screen, and we'll try and answer them at the end of the section. I'm going to go straight on to our next panelist, which is Christian Catalani, is a co-creator of DEMI, formerly Libra, and chief economist of the DEMI Association, and founder of the MIT Crypto Economics Lab and research scientist at MIT. While a professor at MIT, Christian designed the MIT Digital Currency Research Studio. And Christian, without further ado, it's over to you.
Thank you. It's a real pleasure to be here to discuss with you today. So our perspective really at the intersection of stablecoins, what they can do for interoperability in payments and in a financial system, and more generally, what they can do to increase competition in these areas of the economy. From an economics perspective, what is really exciting about what's happening within blockchain and cryptocurrencies is that the tools that were now provided through what's being developed are really ideal for creating new types of digital platforms where you do not have to assign control to centralized intermediaries. This is part of the public and recent debate. When you look at digital platforms, a lot of the concerns arise from the role that the platform architect can have in these systems. What's different about blockchain is that the tools that the technology provides are really a way for enabling a leveling playing field between different participants coming and providing services to consumers and businesses. A lot of this has to do with interoperability. It's a technology that really allows the consumer, say, using one digital wallet to send and receive payments from the consumers of a much larger digital wallet with an installed user base. And so it's really a very efficient way to countervail some of the established network effects that favor incumbents in payments and financial systems. When you think about what's novel here is that we're really transitioning from a world of wallet gardens, closed infrastructure that tries to keep whether it's consumers or merchants within the perimeter of a current provider, to a much more open architecture, one that resembles a lot of what we've seen with the internet over the last few decades. There's a few building blocks behind the technology. One is interoperability that I've already mentioned. The next one is programmability. So think about a situation like the COVID one, where governments were trying to get stimulus checks and stimulus in the hands of consumers. Conditional payments are something that the technology can enable. There's a lot that you can do here, whether it's international aid or sort of other public sector efforts. This wave of change is kind of starting within payments and financial services. You probably have heard about decentralized finance doing kind of some of the similar transformation within finance, but also more broadly, all sort of digital platforms that engage consumers and creators around the curation of content, the sharing of social content, and alike. Now, what's interesting is that Again, there are some clear long-term benefits, and of course, there's work to be done for these to be realized. But in the long term, I think what we can look forward to is more competition, a new wave of innovation in payment financial services and some of these other digital platforms, and more broadly, lower barriers to entry. So new startups coming into the system, providing services in a novel way. From a consumer merchant perspective, lower switching costs. So they will not be locked into any particular solution, and ideally they'll be able to move between different ones through competitive forces. Better privacy. This is a technology that lends itself really well to privacy, also in a compliant fashion. And more in the long term, a further unbundling of a number of products that have been kind of bundled together for historical reasons. Now, of course, with any new technology, it's not just about benefits, there's also new risk. And from a regulatory perspective, how you approach the regulation of this space may require novel approaches. Often regulation works through intermediaries, but in many of these marketplaces and platforms, there is not a clear identified intermediary, given that a key part of this is really removing the control or market power that some of these intermediaries have over our lives today. Which leads me to stablecoins, which I would say is probably the first example at the interface of kind of cryptocurrency and the mainstream potentially. Although most of these assets today are not used for kind of retail applications or merchant payments, there's definitely potential in taking the technology and improving how payments and financial services operate in the economy. The long-term, I think, potential here is really about improving access and competition in payments and financial services. Here you have a list of kind of the G7 countries, and you can see there's wide discrepancy on the degrees of which different populations are unbanked or underbanked, with the United States actually trailing everyone else on this particular dimension. Now, that said, there's been a number of calls for a more robust economic design in the space of stablecoins. Here, you have a quote from Governor Brainerd that compares some of the efforts happening today to the white-cap banking period. And there's definitely truth to some of these concerns. And I think one of the challenges when approaching this space is that the word stablecoin is fundamentally a misnomer. We have an economic research paper where we try to really unpack all the different types of so-called stablecoins out in the market. And when you look under the hood, they have very different assumptions, whether it's in terms of the economic properties of these assets, how they would perform, say, in stress market conditions, what they would do if, for example, consumers or their users were to lose faith in the ecosystem around the stablecoin. Some of these assets, unfortunately, are designed in a way where they could run into a full debt spiral. Think about a traditional currency board that mismanages its accounts and therefore as kind of a run on the currency board and the depreciation. But I think there's a clear roadmap for building very robust stable coins. And a lot of this is really importing a lot of the work that's been done in financial services. And so thinking about not only stable coins that are backed one for one with high quality liquid assets, but also that have the required capital buffers around that to ensure that even in stress market conditions, they can always meet on-demand redemptions. And of course, again, building on the classification, you can think of the gold standard for any stablecoin, so to speak, would be a central bank digital currency. In a recent piece with co-author Zaid Masari in the Harvard Business Review, we also tried to be constructive and propose a few models for going forward in this space. There's often this idea that stablecoins are competing with CBDCs, are competing with the public sector, but when you take a step back, there's actually a lot more opportunity for collaboration in this space. There's been questions around how do you create sound money when you're moving from a world where banks are kind of working on money creation versus one where maybe you also have new types of entities, new types of entrants that can provide payments and other services over time in a slightly different form. And what we identified are at least three not mutually exclusive paths to not only delivering some money in the hands of consumers, but also working at the interface of the public and private sector in a way that can be extremely constructive. I don't have time to go into the details of all the different ideas, but the basic one, the first one is what we call the true stable coins. So think of these as one-to-one backed with HQLAs, narrow bank-like institutions that are really targeting a medium of exchange, a payment tool, something that can really lower costs and frictions for merchants and businesses. Deposit stablecoins, the second category, builds much more on the traditional protection we already have in most countries around deposits. So think about bank capital requirements, FDIC, or in the UK, FSCS. And the last one, which we think is potentially the most interesting in the long run, is this idea of CBDCs on multiple private sector rails. Of course, you could also have competing public sector rails for ensuring universal access and that citizens and others will always have access to central bank liability. But you can imagine the public sector really working on a public-private partnership where, as you work towards CBDCs, stablecoin rails, when properly designed, when they're able to address all the concerns around anti-money laundering, CFT, and everything else, can be actually a complement to what the public sector is doing in this space. Here's a quote actually from the Bank of England that really surfaces, I think, the strong complementarity between what the private sector can do in closing the last mile and creating new use cases, both in cross-border and domestically, and versus what the public sector can do in setting the right guidelines and the right legal frameworks for these to be safe assets that consumers and merchants can use. I'll close by really emphasizing that, again, often in the narrative between stablecoins and CBDCs, it's often described as a war between the two, as a race to deploying these, but very much like the early days of the internet, where you had decades of public sector R&D and work that then really materialized as you had innovation in the commercial sector, the explosion of the commercial internet. I think here you can have a very similar model that, again, builds on a history that we have in creating some money through private-public collaborations and can really deliver new use cases, more financial inclusion, and more importantly, more competition in payments and financial services. Thank you.
Christian, thank you so much for that. I think when you said privacy in the compliant fashion, we started to get a kind of interesting little kind of narrative coming up in the Q&A. So I think we will certainly be returning to some of those elements that you were talking about. So thank you so much indeed. We're going to move on now quickly to Rhomaios. Ram is a former banking executive, including most recently was global head of the product management from transition banking at Deutsche Bank, and has developed an interest in creating digital businesses for finance and for wholesale finance-related areas, and brings a broad swathe of expertise in trading, product management, and technology at his role at Fnality. And we're going to go direct to you now, sir. Nice to see you.
So thank you very much, Martin, and thank you to the APPG for inviting me to this meeting. I really appreciate it, and it's a pleasure to be here. I want to start by giving you kind of a summary overview of my company and what it's aiming to do, and then attempt to describe where we fit in this kind of universe of payments, crypto, stablecoins, etc. And then I'll briefly describe how we're going to improve the settlement landscape for wholesale capital markets. And finally, explain how we're going to use the sort of newly announced Bank of England omnibus account. So it's kind of a more a live explanation of how one of these things might actually work. So although the company was started in 2019, the effort for around what I'm doing started in 2016 as a research project, really to determine if and how the traditional market, or the incumbents basically, could take advantage of the innovations that we see in the crypto space. A key element of bringing digital assets, for want of a better word, to wholesale markets was found to be really creating a compatible cash or payment leg. So in 2016 and 17, those years were really about determining what the properties of such a cash leg would be, and if indeed the criteria that we came up with would be possible. 2018 was about creating an investable proposition, and 2019, when the company was formed, was really about making all of that a reality. Our shareholders are basically some of the most globally systemically important banks who see the need. They basically have a vision for a safe, regulatory compliant digital cash settlement asset compatible with the other digital cash assets that they see coming online. To achieve this outcome, we will develop a set of independent yet interoperable payment systems in multiple jurisdictions. So obviously the UK, but also the US, Euro, Japan, and Canadian jurisdictions. All of these based on obviously blockchain protocols. Each one of these must be able to achieve settlement finality according to the local laws, hence our name, and use a settlement asset with a credit quality very similar to central bank money. And I'll sort of play around with that a little bit later on in the presentation. What's the big advantage? So our payment systems will settle real-time payments in a single currency, as well as foreign exchange instantly, and provide the cash leg for the settlement of securities transactions. So you can do all of that stuff instantly and interoperably. Effectively, we're kind of creating a kind of synthetic CBDC. So it's synthetic because in the case of the UK, the Bank of England is not the issuer of the settlement asset, but the settlement asset does have the same credit risk as central bank money. I saw one of the questions that came up in the questions from Dave Birch was really around the difference between wholesale and retail. So let me be clear on what we're doing. Our focus is on wholesale. So we're really talking about the capital market sphere. We're not at all talking about retail for the thing that we're doing here. Okay, so how do we do that? Crucially, the credit profile is achieved through the opening of a pre-funded omnibus account. So Bank of England just announced a policy like that. The US actually already has this type of account, and actually Europe already has this type of account. And so we'll open one of those. I'll explain the mechanics of it a little bit later on in the presentation. First part is, so where do we fit in this kind of ecosystem of different initiatives? This is very arbitrary, but I picked two axes that don't tell the full story, but should be enough to kind of tell you the main things that people are worried about today. It would be very easy to argue that there are missing dimensions. I fully accept that. But for the purposes of trying to identify where Fnality sits, I think this will do it. So the x-axis is the difference between commercial bank money and central bank money. So commercial bank money is obviously the money that you have at like Barclays or Citibank or Deutsche Bank, any of those types of banks. Central bank money is obviously money that is backed by the central bank. The y-axis is actually about the issue of centralization versus decentralization, so peer-to-peer in what we're trying to do. So in the bottom left-hand quadrant are banks. It's commercial bank money, obviously, because it's commercial banks. Banks are also centralized, so that makes total sense. Stablecoin initiatives typically are also backed by something, so they'd probably be more in the commercial bank money space. We could make an argument about whether they're a fund or commercial bank money. I'm not really here to get into that, but they're essentially in that kind of commercial space, and they would be, but they have the characteristic of being much more peer-to-peer, so they're more decentralized. The public RTGS, so the public payment system like CHAPS in the UK, is centralized, but is central bank money. There are private payment systems, large value payment systems. So there's none in the UK. There are some smaller ones like Faster Payments. Actually, there is a large value payment system in the UK. It's called CLS, which is a cross-currency one. But they're somewhere close to the line of being between commercial bank money and central bank money. The reason I say that is because something like CLS is actually a bank, whereas something like Faster Payments is a payment system. So that's more like what we're doing. We fit in under peer-to-peer and nearly being like a central bank digital currency. So there's no one that's kind of in our space. We are kind of in that top right-hand quadrant. So how are we going to improve the world? So this is a schematic. You don't need to understand everything that's on here of how the wholesale capital markets looks today. So at the top, you can imagine there's a buyer of equities and a seller of equities. So the buyer might be Barclays and the seller might be Santander. It doesn't really matter who they are. They basically place orders in an exchange, one to buy and one to sell, and they match. So that's fantastic. And everyone has a good understanding of that. They probably match on the London Stock Exchange. That also doesn't really matter. It could be OTC, not really of importance to this discussion. But what happens next is where all of the inefficiency is currently in wholesale capital markets. They basically, after finding each other on the exchange, they basically pass the instruction into their kind of the operational parts of their businesses, and they have various intermediaries that help them settle those transactions. They have something called a global custodian, they have local custodians, they have nominees, they have nostro agents. All of those folks are involved in basically finding the same transaction, finding the money, and then putting the right instructions into the clearinghouse and into the payment system in order to allow for some sort of synchronization between the payment of the money versus the payment of the security. So technically, it's called delivery versus payment. So that's how it looks right now. It looks complicated for a reason, because it is kind of complicated. It's a very expensive process that also operationally expensive, but also creates a lot of balance sheet charges, which due to all of the operational efficiencies, which pretty much doesn't help anyone and creates a lot of risk for the market. When you put up a system like Fnality and you have the equivalent securities blockchain, you actually see the picture get much more simple. It basically allows for the removal of lots of these different intermediaries in the roles that they currently have, and so you end up with end up being able to have a much faster, much simpler system that probably will cost a lot less and is much less balance sheet intensive, because you don't need to hold buffers against things not happening. So that's the basic idea of what we're trying to do overall. I said I'd talk again about the Bank of England omnibus account. So this is kind of the critical factor of how we achieve this kind of central bank-like money. In April, the Bank of England published a policy around this account. Essentially, you can see in orange on the right-hand side, they are creating this kind of omnibus account. This diagram is actually taken from their policy itself. The different members will put money into the omnibus account, and then underneath it, there will be a payment system that essentially credits an accounting system with the ownership of the funds in that account. So if member A puts in 100, member B puts in 100, there's 200 in there, and then member A can be paying member B and vice versa, until eventually one of the members wants to take money out of it and they can defund the overall account. Where our blockchain fits in is we are the payment system, and the blockchain is essentially an accounting system that records the ownership of what's in that omnibus account. So that's the mechanism by which it works. It's actually pretty similar in all of the mechanically in all of these stablecoin arrangements. There's some account somewhere, and then where some sort of assets are held. It might be fiat money, it might be something else, and then the record of ownership is basically changed on the blockchain. So that's a short explanation of what we're doing and how we hope to improve things in the UK. I guess something that we're also interested in is what Christian mentioned earlier. We don't think it would be a good idea to completely crowd out private sector with just the public sector arrangements. We think there is benefit to having some sort of allowing the private sector to flourish, and possibly even getting into private sector, public sector partnerships in some way. We think there's a way to do it even with our arrangement. Speaking about the UK specifically, there's a lot of stuff going on in blockchain in the UK, and speaking with my company's interest in mind, we'd definitely like to be able to hire as much talent as we can. So we'd appreciate efforts to help us be able to import the talent that we need. And then I guess the final point is the UK can actually speed this adoption of kind of blockchain in traditional markets up by essentially doing things like issuing government bonds on blockchain when those come about. So it could be that the Treasury decides to issue some proportion of the next issuance on blockchain, and people can start interacting on that, and that can be a driver towards making the UK a center for this type of innovation. I'm going to stop there, so thank you very much.
Thank you very much. So that was fantastic. I think we'll certainly kind of line up a few questions, especially for those of us who are parliamentarians, making some of the kind of discussions and the debate around how companies, regulators, and also public service delivery and also markets are regulated. So posing some very, I think, kind of interesting things for us to consider and maybe ask questions once we come to the end of the session. I'm going to move now on to Jonny, Vice Advisor at Stratis platform. He founded and was the CEO 20 years plus. Premier Asset Management PLC, a mutual fund company listed on the London Stock Exchange. He writes his Digital Bytes, a weekly analysis of how and why where blockchain technology and digital assets are used. Actually, there's also an own radio show, which is broadcast in 140 countries. Jonny, I've got a face for radio, so I look forward to being invited onto that to discuss blockchain, and I look forward to speaking to 140 countries about some of the opportunities and innovation that blockchain-like technology brings forward. But without further ado, sir, over to you.
Thank you very much indeed. And thank you to Birgitte and the team for organising this evening's event. What I'd like to do on behalf of Stratis platform is to actually talk to you initially about some of the potential use cases, in particular for stable coins. And I'd like to keep it in a very simplistic fashion and try and give you some maybe not slightly alternative view, because when we talk about certainly central bank digital currencies, when we talk about stable coins, what people tend to get focused on is very much about payments and transfers, and say, well, what we need to do is we need to have a digital currency, because that'll then enable us to make payments more efficient and faster. And without a doubt, that is very, very important. However, I think what's interesting, if we look at the development of digital currencies, and we look at, for example, the dreaded Bitcoin and cryptocurrencies, what we've seen over the last 5 years is a complete turning on your head in the sense of those people that are interested in engaging in this. So, we saw a situation whereby, 4 or 5 years ago, all the talk was about cryptocurrencies, and it was basically the cyberpunks, the people that wanted to get around the banks, get around the regulators, and be able to move value, be able to move money in a way that perhaps could be discreet, for whatever reason that is. And now what we're actually seeing is completely the other way around. We're actually seeing banks, and we're seeing governments, and we're seeing financial institutions realizing that the technology that can drive some of these digital currencies can have some really, really important beneficial impacts on society as a whole. Now, just in the UK, we have 1 million people who are unbanked. Globally, we have something in excess of 1.7 billion. Yet out of that 1.7 billion, according to the World Economic Forum, 66% of those people have a mobile phone, and therefore would be able to become banked, would be able to come into the financial system if they actually were able to have access to some form of digital currency that they could trust and they could move between themselves. But talking about sort of alternative use cases, we believe at Stratis that actually stablecoins in particular are perversely governments and regulators and treasury departments. They're their new friend. And the reason for that, and we've already heard in previous speakers talking about how this thing called transparency, and if there's one word that I would like you to take away from tonight, and that is this thing of blockchain technology, which we very crudely refer to as an Excel spreadsheet on steroids. It's just simply holding information, holding a ledger, whereby it's held in a very, very secure fashion. But what it can do is can actually give you transparency as who owns what, how, where, and where does it come from. So rather than digital currencies being seen as something which people should be frightened of because you can move money and, if you like, not through the normal system, it effectively leaves a digital footprint. Now that's really, really important, because from a compliance point of view, we have a situation, I personally was CEO of a public and regulated company, and I was spending 20% of my time on compliance. And a lot of that compliance is around box ticking, as opposed to managing the risks within the business. And we have a huge financial services system. And if you talk to any bank, any regulated company, one of the biggest challenges that they face is actually being able to manage the risk, as opposed to being able to prove that they've managed the risk. So what stablecoins effectively do is they have the ability to be able to create structured information. And with that structured information, you can overlay smart contracts. So these are, again, thinking very simplistic terms, they're like a flow chart. If this happens, then we make the payment. If that happens, we don't make the payment. Now, one of the reasons we have financial services regulators around the world is to treat customers fairly. So let's look at the situation of a dividend. Now, let's say I own shares in BP and I decide to sell my shares in BP after 5 months and 30 days. And Martin, you decide that you want to buy those shares. Well, what happens is that I've had all the risk of owning those BP shares for 5 months and 30 days. You come along and you actually buy the shares the day before it goes ex-div. You get the dividends and I actually don't get the income. Now, in the same way, right now in Wall Street, you have no idea who owns Microsoft, Tesla, IBM, any quoted company, nor do we have any idea right now who owns those companies in the UK. In about 2 or 3 hours time, when the share registrars have totted up the buys and sales, we'll be able to give you a picture in time. But as we start seeing assets such as equities, bonds, commodities, property, and currencies being able to be traded in real time, then it'll give the regulators and it'll give the compliance and the risk management departments the ability to see in real time who owns those assets. And we'll be able to start paying coupons and dividends and rental income based on the duration of holdings. So we're going to start treating our customers more fairly in a way it's just impossible with sort of paper-based analog type systems. Now, because of that transparency, there is no reason why, we'll use the example of BP, but nothing to do with BP, but it's just a name that we've all heard of. If they actually had their own coin and they could actually then pay possibly their staff, their suppliers in their own coin, but the money itself is held by one of the clearing banks, let's say. So there's no extra risk, but it means they can move their money around much more clearly and much more easily. And there's no reason why they couldn't say to their bankers, to their shareholders, potentially to a government, say, this is what our cash position is on a weekly basis, as opposed to having to wait for sort of interim and final accounts, which, as we all know, are, you know, a little bit out of date, just to sort of, to say the least. So what we have the ability with stable coins, and in particular, is the ability to then for the banks to start competing against the payment platforms. You've got companies like Apple Pay have over 500 million customers. You have PayPal, which is worth almost 50% of the same as the biggest bank outside of China, JP Morgan, is worth 50% the value of JP Morgan. Visa is actually worth something nearly the same as JP Morgan. And what they've been doing, they've actually been embracing digital currencies. And the announcement actually only in the last 24 hours that MasterCard are now going to be able to say to their 20,000 businesses that interact with them that are regulated, and their millions of merchants and the 2.8 billion cards that they've issued, you can start using digital assets. Now, maybe being cynical in the saying, well, because Visa sponsored the Olympics in Beijing, they actually want to be able to undermine everyone and say, okay, well, you can use the Chinese digital currency, which is coming out in February 2022 into the Beijing Olympics. Or maybe they're just saying, we're now putting down the infrastructure, we're putting down the rails, which will enable central bank digital currencies to be able to issue them. Now, going back into the institutional area, we've heard a couple of people mention this thing called DeFi, decentralized finance. Now, there's potentially a huge opportunity to see arguably the biggest asset class in the world, i.e. derivatives, moving on to blockchain related platforms. And if they're doing that, why would they go back to the paper-based systems when they could actually use a digital currency? Now, this isn't just pie in the sky. And, you know, some of the work we've been doing here at Stratis has been looking at some really interesting opportunities, but it's not just us. Look at the International Settlement Derivatives Association, ISDA, or look at the DTCC in America that last year settled, I think it was $10 trillion worth of derivatives. Both of those are looking to implement smart contracts on a blockchain powered platform, and they're going to have to start settling and trading and making payments. Well, again, I'd argue that it would probably safer and more secure to have those payments made automatically, just as Ryan was saying earlier on, stripping out a lot of the intermediaries, which have been built up because we really came from writing things down with a feathered quill. But the markets have moved on. But it's not just in the area of financial services. One of the huge areas I think that we're going to see stable coins being used in around loyalty schemes. And so it was very interesting to see in France, Casino, which is a French supermarket with 11,000 outlets in Europe and Latin America, have created their own stable coin. And in the first 3 months, although it's only got 7 million of value in it, it's actually had a turnover over 100 million euros. So that's indicating the sort of potential demand with a very small amount of money, but actually the actual sort of turnover. And other global firms, they're now accepting these digital currencies such as Amazon, Visa, Microsoft, Sotheby's, Coca-Cola. And what we're seeing increasingly is some of the systems and processes that we have at the moment in the banking world are not fit for purpose. And we've talked about the fact that we've got so many people who are unbanked. But the big problem the world is facing, I would argue, and that is the shadow, the informal economy. Now, the informal economy employs about 1.8 billion a year. Now, unfortunately, every single one of you listening to this are part of it. Now, you're probably not running drugs, and you're probably not sort of, running child labor schemes. All of you will have given someone a tip. I certainly hope you will have, for good service in a restaurant, or maybe someone's cut the grass or cleaned your car. But did you think, hang on, I'm doing the government out of some tax? So what we're actually seeing is that, how do governments fight this informal economy? And arguably a central bank digital currency or increased use of stable coins will enable people to actually more and more be inclusive, and they will no longer be able to not pay the tax that's actually being required. And I'd argue that's one of the main drivers we're seeing central bank digital currencies. And at one extreme, we've seen the situation in China, whereby what they've been doing in order to encourage people to start using their digital currency, they've actually been saying, okay, so what we're going to do, we're actually going to give you the equivalent of $30 in a raffle. So we've got 50,000 people in a big city, and you can start to get to use it. However, you have 5 days to use the currency, use it or lose it. And you can only actually spend it at these 3 or 4 different places. So they're actually directing their citizens to be able to spend money in a certain way, so they know who, when, and how. Now, maybe in other countries, they would argue that's not a good idea. But we have a situation at the moment whereby, as I refer to, Australian OXO, i.e. cash, is actually being responsible for billions and billions of nefarious activities. And it's the banks that are being fined consistently billions. And to Dion's credit, to Christina, you came up with the concept of this sort of digital payment mechanism, and everyone in the banking world suddenly sat up and listened in 2018, because Facebook, with 2.8 billion people that log on every single month, you suddenly put stable coins right at the forefront. And there's no surprise that the Bank of International Settlement is saying that actually 80% of our members are now looking at various different central bank digital currencies.
Jonny, sorry to interrupt, but we're just coming, they're going to over time at the moment. So I'm just wondering if you could maybe bring your thoughts into a conclusion before we need to move on. It'd be really much appreciated if you could. Sure. Really sorry to interrupt.
Sure. I think the main thing is that this isn't about just bank settlements and bank transfers of money. This is something which is going to impact right across society, and it's something which we have to grasp before other countries actually steal a march on what's happening in the UK. And that would be my real message, I suppose, for this evening.
Thank you so much, Jonny. I think you kind of posed a range of really complex issues there, but and also some really kind of issues that we can maybe get our teeth into during the Q&A. But I'll maybe just move straight on to our next speaker. Again, I'm glad I'm able to say this first time. You can always say going live to Washington. For those who know, it sounds like a Eurovision presentation. We'll go to the Washington jury. I'm delighted to welcome Commissioner Hester Peirce, is the U.S. Securities and Exchange from the U.S. Securities and Exchange Commission, appointed under President Trump to the position and sworn on January 11th, 2018. But I also just to say, just be on the other side of the aisle, that the commissioner will also, the previous president had sought to appoint the commissioner during the presidency of Barack Obama. So we're delighted to welcome you, Commissioner. I think you're going to bring some challenges to the rest of the panel and to our audience, and really looking forward to hear what you have to say to us this evening. And we're delighted to welcome you. So straight over to you.
Well, thank you, and thanks to APPG for having me. This is a real honor. I do have to start with a few disclaimers. First is that the views that I represent are my own views and not necessarily those of the U.S. Securities and Exchange Commission or my fellow commissioners. Second, I would say I'm not an economist. And third, if I were an economist, I would not be a monetary economist. I'd be a microeconomist. So you can apply those disclaimers as you listen to me. And I will try to keep my remarks short. I think we've heard a lot, and I've seen that there are quite a few questions coming in. So let me just say a few words, and then we can switch into a more interactive discussion. So the SEC, among other US regulators, is now kind of confronting the fact that stablecoins have grown quite dramatically in use. And so we're all looking at each other and saying, all right, what are the regulatory implications of this growth? If this growth trend continues, what are the potential financial stability implications? What are the potential customer or investor protection implications? And so how do we need to be thinking about this? And because the growth of stablecoins is facilitating the growth of things like decentralized finance, which pose unique challenges to regulators, whatever we do in the space with respect to stablecoins will have follow-on effects. So how are we thinking about that? And it is very much a live conversation in the US now. We have not yet sorted out who has jurisdiction over stablecoins. There has also been state involvement. So there are a lot of federal financial regulators in the US, but this is an area where state regulators have also gotten involved. So I think one message I have for you is just stay tuned to see what happens in the US. As I think about regulation in this space, there are a few things that I think are important to remember. First of all, is that people are finding stablecoins to be valuable. And so we should, as we think about regulation and we think about imposing new burdens on stablecoins, we need to think about what the reduction in benefits will be and take that into account. Second, we have to be very careful with broad generalizations. There's a lot of variety in stablecoins. I think we heard some about that already today. And so making sure that as we think about regulating, we're not writing one size fits all rules. Third, while stablecoins are new, there are a lot of other things that look a lot like stablecoins out there. And so for writing rules intended to capture stablecoins, we may well capture something else. Fourth, in the US, there have been a lot of conversations around, or a lot of comparisons between stablecoins and private currencies of the 19th century in the US, private banknotes. I think that some of those conversations have been a bit ill-informed in terms of what actually happened and what led to some of the dynamics with those private banknotes in the past. There have been very successful systems, including in Scotland, with private banknotes. So we should bear that in mind as we try to draw parallels. They may or may not work well. And then I would say that I just quote from a banking regulator, Federal Reserve Vice Chair Randall Quarles explained, I think helpfully, that we do not need to fear stablecoins. This is, I'm quoting him. The Federal Reserve has traditionally supported responsible private sector innovation. Consistent with this tradition, I believe that we must take strong account of the potential benefits of stablecoins, including the possibility that a US dollar stablecoin might support the role of the dollar in the global economy. And so I think that brings me to the topic of CBDCs. And again, I'm not speaking for the SEC. I'm certainly not speaking for the Fed. But I think stablecoins are an interesting development, and maybe the American answer to a CBDC that other countries might want to adopt. We like to allow some competition, which having multiple private stablecoins will do. And we also like to have a little bit of a buffer between people's private financial transactions and government oversight. I think we've heard earlier this evening about there's some benefits to having government have greater oversight, but there are also definitely some drawbacks. And I think that's, for me, a key question. I think financial privacy is fundamentally important. What people do with their money goes very much to the core of who they are. And so I think we need to be very careful to guard that. And that's why stablecoins may have a leg up on CBDCs. So I'm going to end with that and just look forward to the upcoming discussion. Thank you.
Commissioner, thank you so much. It was interesting you mentioned Scottish banknotes. Of course, I think what most people will probably forget is that Bank of Scotland, when it was founded in 1695 and given its mandate by the then Parliament of Scotland in Edinburgh was more or less kind of, I suppose, supported by the then Scottish Parliament as a kind of fiat state currency, even though it was technically in the private sector. So it was a very interesting analogy that you gave, and it's certainly one I will be taking away in relation to this. I know that we've got a range of questions that people are looking. We've wondered that Dave Birch had brought up one about retail CBDC operates internationally. If it does, then won't most currencies vanish? And who would hold, for example, the Tanzanian shillings when they can hold dollars instead? So I'm just wondering if any of our panel would maybe want to come in and try and defend the Tanzanian shilling by any chance. If there's anyone wants to go for that. No one? Christian, do you maybe want to come in there?
Yeah, happy to. So I think it really depends on how all of this is implemented. And similar challenges have been raised with stable coins, talking about how stable coins could increase capital outflows, out money flows, and the like. It all really depends on careful design. So if you imagine a system where to access a stablecoin, you have to go through a regulated participant, whether it's a money transmitter or some other entity that's regulated in the right jurisdiction, then you can really port all the protections that we have in the current system and really avoid interfering with local macroprudential policies and really stopping capital substitution. Just to be extremely practical, you can imagine a model where even if you have a dollar-denominated stablecoin that's extensively used for sending remittances, which we know have been particularly important during the COVID crisis, you could have those flows happening in the stablecoin dollar-denominated, and then having a balance limit at the local level where if you receive it, you have to convert it into local fiat. That way you get the benefits of stablecoins, you get the benefits of lower cost, lower friction, but you don't get threats to sovereignty in the incoming jurisdiction.
Maybe I want to challenge some of the panelists in terms of the issue of privacy and what we do with our own money. And I think some discussion can be around about those of us who are not, chairs of substantial large corporations. We are lower down the financial food chain. But I'm wondering, is there any concern that this type of approach to stable coin or the utilization of it, if privacy is the primacy, is there a concern that some of that money may be utilized for what I would call nefarious and dubious reasons, and that's allowed to be unregulated? Commissioner, I don't know, maybe you might want to come in there at some point.
Well, I do have concerns about, of course, as all citizens do, we have concerns about the use of any kind of money for illicit purposes. And so in the United States, we've built up a pretty extensive know your customer anti-money laundering regime. And that applies to a lot of the on-ramps. As Christian mentioned, it applies to on-ramps to crypto as well. I think this is a good moment, though, for us to consider again as we weigh the balance, right? There's always a balance. It's great to be able to stop illicit activity, and we need to have measures in place for that. But it's also bad to track people in their private financial lives, people who are not suspected of any wrongdoing. And so I think it does make sense for us to take a step back periodically and say, do we have that balance right? And this is a moment that we can do that because the new technologies allow for a new level of surveillance. And so in some ways make it easier for regulators. We found that in the United States, where we've been actually quite successful at going after folks who have used crypto for illicit purposes. But they also call into question, allow us to ask the question of whether we are getting the balance right, because clearly there are some citizens who feel that we're not and that they want more privacy. So let's have that conversation.
Thank you. I've got one question. Sorry, I think.
Yeah, Martin, it's Jonny here.
Yeah.
Can I come in there?
Yeah.
The whole thing around security or personal identity is very much wrapped up with, as Commissioner Hester says, in terms of if we look at the current system, is the current system working in the sense that Do we find that there are no illicit activities going on? Do we find there is no need for the likes of the FCA and SEC and FINRA and other regulators because the current paper-based system is working? And the answer is absolutely not. So what we need to do is need to use technology, and we need to be able to say, well, okay, you don't need to know all of my personal details. That information can be held in a digitized, secure way. But what we do need to do is to make sure that if I want to transfer and pay money for one person or another, then the, if you like, the compliance checks, the regulation can be done before, not after the transaction. And it can be done ideally automatically and on a machine that can work 24 hours a day, 7 days a week, as opposed to someone ticking boxes of paper. And I think, as Commissioner said, it's looking at the current system. It's not fit for purpose. We are seeing consistent fines and breaches. And what we don't want to do is to basically have a sledgehammer to crack a nut, but say, is there an alternative way? And I think that's really what we're proposing here, to actually use technology that's been around a long time to actually move money in an alternative way, which is safer and more compliant.
Yeah, I mean, I think, and I don't want to maybe take up too much because I know we've not very much time, I suppose. The question also for parliamentarians is that technology then is not utilized by larger players in the financial market to hide, money when they should be paying tax. It's not for those of us lower down the financial food chain who would pay an extra tiny little bit of tax when you have larger players who are not paying huge swathes in terms of the value they take out of the state and also the citizen who makes it up. Maybe I want to go on to one question. I don't know who it's from. I'm a commercial banker, and what I've heard today worries me. How do panelists see the role of commercial banks once a CBDC has been adopted? Anyone want to go for takers on that?
Very
Jonny?
quick,
yeah,
very
and then I'll bring in Rhomaios as well. Okay, on you go.
Yeah.
Quickly.
Very quickly, if you've got £10,000 with one of the high street banks and you have the opportunity to actually have it lodged and guaranteed and backed by the government, why would you leave it with a commercial bank? And this is one of the big problems that CBDCs face, because if you move your money from the, if you like, the commercial sector to, if you like, give it to the Bank of England, in that case, what happens to our crazy world of fractional banking, which is only 50 years old, but the retail banks potentially would have an absolute implosion, and their so-called stable balance sheets, which are leveraged 20-fold, would be annihilated overnight. So we can't have a situation whereby the man and lady in the street can take the money out of the high street banks and give it to the Bank of England, because where does the liquidity come from?
Yeah, and Rhomaios, you want to come in there as well?
I was going to say roughly the same thing. So I think most of the central banks have that, have that concern themselves, and that's why, for example, the lady who was talking about the digital euro, they're planning on having some sort of limit on how much money you can have in central bank digital currency. I can't remember whether it was 3,000 euros or 300 euros, but there's some limit, and that's also. But that is a thing that is definitely a concern for the central bankers, because you will contract the economy the way that it's currently run if you start to remove the ability to have fractional reserve banking.
Thank you. I know we're really tight for time. I maybe just wanted to bring one kind of final political question. And it's not party political, it's just as being a parliamentarian, an elected parliamentarian in a parliamentary democracy, the role of regulation to ensure that our type of parliamentary, or for that matter, democratic life continues. I've heard mentioned, for example, in terms of Chinese digital currencies and their role in, say, stablecoin or CBDC in the future. Is there any concerns for those on the panel that we need to make sure there is a democratic answer to their control, or what could be perceived as control of, say, stablecoins and the systems in which markets are built on? I'm just wondering, for example, Commissioner, do you have any fears about, I'll be very blunt, communist China's role in utilizing the technology and in markets?
I am very optimistic that a system that's based on, that respects privacy, is based on private innovation, will win out over a centrally controlled system that is based on having information about people's financial transactions, the government having information about people's minute financial transactions. And that's another reason why I think ultimately it's unlikely that a central bank will want to become banker to every retail investor, retail customer. And so I really think that if you put those two systems side by side, a private competitive system versus a central system, the private competitive system will win.
Okay, and does anyone else want to come in on that one at all?
Well, Martin, all I'd say is that this mixture of a central bank digital currency and a series of stable coins, I think is the sensible way forward, and having the competition. If we don't have competition, then you could well see one entity dominate, whether that's a quoted company or whether that's a government. But make no doubt, these things are coming because they give the governments an extra tool in their armory to be able to control their economies. But alongside that, we need to see open regulation in order for the more practical purpose at a retail level to be able to also come to fruition, I think.
Thank you. As any other panelists want to come in before we kind of bring our evening to a conclusion? Well, thank you. I think, Jonny, actually, I think you say these things are coming. Is that a nice way to end? Because I would often say that these things are already here. Sorry, being on the side of the River Thames means that people will go past in boats and make large noises, in case you were wondering what that was. So I think, these things are already here, and certainly central banks and governments across the world, no matter their model, are really looking at this and the issue. And as a parliamentarian, it's really, I think, the onus is on us to make sure that those policies and regulations are fit for purpose and fit the needs of our citizens. I'm extremely grateful for our panelists joining us this evening from all over. Commissioner, thank you so much. Christiane, Jonny, Rhomaios, I'm delighted you're able to join us. For our sponsors this evening as well, extremely grateful. And I just maybe want to ask Birgitte if you want to say a few final words before we bring this evening to a conclusion.
Well, I just want to add that I thought it was really interesting, and that we will be bringing in all the evidence given. This will be thoroughly edited and shared with parliamentarians and policy bodies in the UK. So we'll learn more from it and investigate what needs to be investigated. So thank you everybody for coming, and I hope as many of you can join our major UK blockchain landscaping of all sectors, including finance and digital currencies on the 3rd of November. Thank you.
Indeed, that's going to be a big event for blockchain in these islands next week, and looking forward to that. And well, I suppose live from the House of Commons here in London, delighted to have been able to host this evening. Again, thank you to Birgitte, to Fernando and all the team behind the scenes. And hopefully we'll see you, if not next week, at our next all-parliamentary group live here on Zoom. So good night, and thank you very much, everyone. Stay safe.